Today, February 1st, we're going to do more work with financial statements. As you see on the screen, there are two, given there the balance sheet and the income statement. Based on the work you've done so far, I think some of you are a little less than completely understanding the balance sheet. So I want to do a little bit with that. And then we'll look at the income statement. You see two statements there, both from the XYZ company. Let's look at that balance sheet. If you remember that the balance sheet is based on the accounting equation you see at the bottom there, basically stated in two ways, at least typically. Assets equal liabilities plus owner's equity, or you can see it another way, meaning the same thing, assets minus liabilities equal owner's equity. So on our example here, we have total assets of $557,900. We have that simple total there. And on the other side of the balance sheet, we have total liabilities. That number is found simply by adding up those four liabilities, things that we owe. If you subtract total liabilities from total assets, you will arrive at $271,900. That would be the owner's equity. To make it maybe a little clearer, I've made the balance sheet actually balance. On the left side, you see the total assets. On the right side, the same number, $557,900, is a total of the liabilities and the owner's equity. Again, based on that accounting equation you see below. So the two sides of the balance sheet indeed balance. Let's look at a couple of the things in there. You see on the left side cash, a very obvious and typical asset, and that could be a total of all the money we have in the cash register, in the savings account, everything that we have on hand as far as actual cash. Accounts receivable, as you now know, indicates that people owe us money, considered to be an asset. We will eventually get that money. We have inventory. These are the things we will sell. We have $116,000 in value as far as inventory, and that is money that we hope to gain, things that we hope to sell, but we haven't done it yet. So inventory on hand. It's not sold yet, but it is an asset. We have something of value. We own an office building. We have some office furniture, computers, supplies, and a delivery truck. Okay. On the right side, we have accounts payable. We owe money to somebody in the amount of $112,000. So this is a liability, something that we owe. Typically, as you hopefully remember from the video you had yesterday, accounts payable would encompass things that we owe in the short term. So typically, these are things that we owe within a month or so. So we need to get those paid off. Longer terms are sometimes differentiated, longer term liabilities. This is a mortgage. Typically over 15 up to 30 years we have to pay off the company building. So we owe $150,000. The office building is valued over here on the left at $200,000. We owe $150,000. So in theory, if we sold it, we'd end up with a net of $50,000. Obviously, we're not going to do that. We owe money on the delivery truck. Delivery truck on the left is an asset valued at $30,500, and we have a loan on that delivery truck, and we still owe $21,000. Same way with the computers. We owe some money, $3,000 on the computers. So those all add up, those liabilities add up to a number which subtracted from the total assets would give us the value of the business to the owners. The owner's equity, sometimes called the net worth, sometimes called capital. So Those are key items on the balance sheet. And remember, a balance sheet is only good on one date. So in this case, January 31, 2017. By the end of February, it will have changed in some fashion, and we will need to construct another balance sheet. So let's go on to the other statement. The other side of this particular screen is showing you the XYZ company's income statement. And this is for a period of time. This is for the month of January 2017. And it may well happen that this income statement is constructed on a monthly basis, and at the end of the year you would have an annual income statement showing the entire year. So some parts of that. There are really two parts: revenue and expenses. Under revenue, typically there are sales, and that can be broken down in much more detail, but we're keeping it simple here. So total sales in this month, 10,000. And then we have some expenses. And what we want to do, I think, is spend a little bit of time differentiating between an expense in the income statement and all of these liabilities back over in the balance sheet. Now, let's take a look at this one on the income statement. Under expenses, you see rent expense, and we are apparently renting a storage building. Now, back over on the balance sheet, let's go back over under assets. Nowhere here do you see storage building listed as an asset because we do not own it, so it cannot be an asset. But it has something to do with the income statement. Expenses are things that are really the cost of doing business. These are things that we really don't own. We can't sell that storage building, but we need to have it. We need to keep some of the inventory someplace. So we obviously keep the inventory in our storage building, but we have to pay an amount of money for that. The rent expense is $5,000. Now, is that an annual expense? No, it's not, because this is an income statement for January, for the month. So for the month of January, we had to pay $5,000 to rent this storage building. We have some other expenses. Advertising expense, $1,300. Gasoline and oil expense for that delivery truck that we have, $600. Electrical expense, heating expense. These are all considered cost of doing business. And if you think about it, we don't own these things. If we wanted to, back on the balance sheet, we have that delivery truck. We could probably sell that if we wanted to. It is an asset, and we could sell it and make some money on that if we wanted to. But we can't very well sell the gasoline and the oil. That's just an expense of keeping the truck running. We can't sell the electricity that we use. We can't sell the heat that we use. This is just a cost of doing business. So it's important to understand the difference between expenses on the income statement and liabilities on the balance sheet. If you look at those liabilities again, in each case, accounts payable, mortgage, loan on the truck, loan on the computers, on the balance sheet, those are liabilities. And that indicates something that we owe, but the point is we got something of value in return. Accounts payable doesn't specify that, not on this balance sheet anyway. But we got something of value. We got an asset, so that's why this is a liability. A mortgage is something that we owe because we bought that company, that building, and we're going to have to pay the mortgage. We got a delivery truck, but we owe money on it. So we owe $21,000, but the delivery truck is an asset. We got something of value. Same way with the computers. We got something of value. Back on the income statement, again, the rent expense is simply a cost of doing business. It's not a liability because we don't get anything. We don't get the storage building. We don't own that. So that's considered to be an expense. Okay? Now, I'm spending a lot of time with this, and it may be repetitious, but it's really important, as we will see later on in the course. You need to have a firm idea of the difference between assets and liabilities. And even more important, more confusing probably, is the difference between liabilities and expenses. So if you have questions on any of this, you've got a way to send me a message on your course page. So do so if you're still confused. On the income statement, then, we have just a few expenses. They add up to 8825. And when you subtract total expenses from total revenue, in this case sales, you get a figure of $1,175. So that's the picture of the XYZ company at this point. Later on, we'll talk about interpreting statements and giving advice to the owners as far as what this means. On a very quick glance at this, we can see that on the balance sheet, we have a lot of money tied up in inventory. We have a lot of inventory here. And we owe quite a bit of money on the accounts payable and the mortgage and so forth. At the same time, for this month of January, on the income statement, we see we made just over $1,000. Maybe not a whole lot, maybe a bit of a concern if we're making that much money. You spread that over 12 months, and it's not a huge amount of income for the company. So we'll talk more about interpreting statements later on. But it's important, as I said, to understand, one, how to construct balance sheets and income statements, and two, deciding which types of accounts, these are all called accounts, which ones go where. Tomorrow you're going to have an assignment. I'm going to give you a bunch of things, loans and sales and expenses and assets, and ask you to put them in the proper place on either the balance sheet or the income statement. So we will have that exercise tomorrow. Okay, so at this point, we're going to end this lesson. As I said, just remember that message, little box on your course page is there for a reason. If you have questions, you're not quite understanding how all of this works, you need to let me know. I've also left some comments on the assignment from last Friday and the assignment from yesterday. So go to your grades, take a look at the points that you earned for the assignments, but also look at the comments that I made, because some of you seem to be a little confused about a couple things, and I've made some comments about that. So take a look at that. Again, if you have questions, let me know. The end of this is the end of this particular lesson. Thank you.